Okay, I think we can get started. So obviously, thank you so much for joining today. This is part of the CWDL webinar series on key mortgage topics for our clients and friends in the industry. We're super lucky today to have two of the very best with us. I guess I'm leaving Dustin out, but so we'll say three of the very best. Please join me in welcoming Troy Garris of Garris Horn LLP and Josh Weinberg of Firstline Compliance. Both are industry giants and work diligently to know all things compliance. Moderating will be CWDL's very own Dustin Pfluger, mortgage banking partner. Today, we're going to be discussing regulatory changes as well as how to do more with less in 2024. Couple of housekeeping items. We like this to be as interactive as possible, so please type your questions in the chat. We will do our best to get to all of them. If we don't, we'll follow up. Other than that, let's get started.
Okay, well, thank you, Casey. Thank you, Josh. Thank you, Troy, for joining us today, and thanks to everybody else who's on the call right now. So yeah, as Casey touched on, I mean, we're going to cover a few things today. We're going to go over some MCR and call report changes, get into kind of some of the regulator and state examiner changes we've been seeing so far this year, and then wrap up kind of with how to still stay efficient and effective, and within your compliance department, how to kind of make sure you're staying compliant, but the most efficient manner possible. And then at the end, we might cover some other just hot topics as we have time. Maybe, cover some of the stuff coming out of the last legal issues conference that was last week or so, or NMLS conference. So yeah, with that, I guess we can go ahead and get started. So jumping out, we were talking, we originally talking about doing a webinar just on the MCR and call report changes, but realized it'd be kind of quite boring to cover that for an hour. It would take a lot of talking and stuff. So we decided to make it one bullet point of this, kind of hit the highlights, see what's going on for Q1. So I guess with that, Josh, why don't you jump into it, kind of talk about what you've seen. I know you were on the steering committee, if I'm right, for the changes. So we have some inside look. So why don't you jump in and just kind of start with what's going on there, who's required now, what changes for everybody that's been required. So yeah, go ahead.
Awesome. Thanks, Dustin. Thanks, everyone, for joining. Pleasure to be here. Clearly, I missed the memo on the blue sport coat and white shirt. I'll get that next time. So the call reports, hopefully not new news to everyone, but the Q1 call reports for 2024 have an initial due date of May 15th. I say initial due date because of the significant number of changes and the complexity of the changes. A majority of the states have actually extended the submission timeline for call reports. It's important to remember and keep in mind, though, we don't have the option of submitting some states and not submitting others. It's an all or nothing approach. So when we're getting ready to submit the call reports, I would say first we need to be prepared and review or identify, are we ready to submit in all of our states? Or are some of the states that we need to submit following this leniency and extended time frame to file, or are we kind of in a split the baby scenario? I would say to the extent your data is relatively good, even if you have some updates or changes to make, file on time. Communicate with your regulators. If you have questions, if you have issues that need to be resolved, we have the ability to refile. All the regulators have said they will be understanding for refiling so long as the filings we make will be based on good faith efforts. Where there's this breakout is states that have actually said, if you're not ready, you may file late. Again, that causes a conflict if you're filing late for some and on time for others. So if we have to file on time, kind of that lowest denominator approach of serving the regulator that and has the earliest deadline, if you are going to file with accurate data in some states, and your only approach for filing in others is to file zeros, make sure to reach out to your state regulators to let them know you will be refiling that data. For most states, if they see filings that reflect just zeros, they are going to interpret that to be you did not make good faith efforts to file on time. So if you are in states that allow the grace period, and you're unsure of your data, you may want to file later than May 15th, but on time with their extended grace periods. I would say while this is somewhat confusing on the states and which file late and not, the main point or the common thread is communicate with your regulator. To the extent there are questions, there are challenges, reach out to them. There also is the opportunity to reach out directly to the NMLS to get clarifications or confirmations. And they have actually created an entirely separate email group just for call report issues. That email address, I'm hoping, is mcrv6@csbs.org. Again, mcrv6@csbs.org. And that can take specific questions related to version 6. Before I hand it back, I do just want to highlight a couple of things. The NMLS and CSBS groups have put a lot of information available on the NMLS Resource Center. The NMLS Resource Center recently changed the look and feel, but the information is there. So if you go to the NMLS Resource Center, which is mortgage.nationwidelicensingsystem.org, you will get to the NMLS Resource Center. Under the right side, under popular links, there is a link for Mortgage Call Report. That will bring you to a ton of information, sample versions of the Mortgage Call Report, field definitions, red line definitions between changes for version 5 and version 6, explanations for new fields that are added. Two highlights, because I think this is important. There are some helpful changes. I think we often look at changes as negative, but there were a couple included that I think are really helpful. One is mortgage loan originators who held a license but had no activity in a state are no longer required to be included in the MLO portion of the filings. That is, we will only include MLOs who actually had loan activity on the call reports. That's one big shift. The other, or one of the others, is that there is now a separation, a clear separation on which reports and which components get filed based on your business activities. So mortgage brokers, if you are only a mortgage broker, will file a very limited set of data and fields in the call report. Lenders will have another set of fields and requirements, and servicers will have an additional set of requirements. If you happen to be a mortgage broker, a lender, and a servicer, you're going to have to do all three. If you are only one of the three, then the filings that you'll have to submit or the fields you'll need to complete will be more limited. Let me pause there, see if there's some other clarifications, and then I'll talk for a minute.
Yeah, on that last point, I have two clarification things. On the last point, though, the latter two, the lender and the servicers have always had to fill out in MLS, and then if I'm getting this right, the brokers, it's relatively new for them, or is it just a new limited form? Sorry, touch on that.
Yeah, no, it's a good distinction. So the primary change between version 5 and version 6 of the call reports is it broke away from the concept of the standard and expanded version of the call reports. So in version 5 and before, the expanded version was only required to be filed by lenders who were approved by Fannie or Freddie or one of the agencies.
Got it.
So if you were a lender but not approved by a GSE, you still filed the standard. Mortgage brokers also filed the standard. Now, there's no breakout based on GSE approval. It's only based on business activity. So that impacts not only the fields that we file within the mortgage call report, it also impacts the financial condition report. So mortgage brokers will only file an annual financial condition report. Lenders and servicers will file a quarterly financial condition report. One other kind of clarification there, when you see under the financial condition components, when we're doing these filings, you will see annual initial. That will only be for mortgage brokers. Lenders and servicers will now use Q1, Q2, Q3, or Q4.
Got it. Okay. That's where I was confused. Got it. Okay. Thanks for clarifying that, Josh. I guess the one other clarification point I want to make sure we hit at the beginning. So what you were saying at the beginning is, even if they're not 100% ready to go, it sounds like the safe bet is to file, make the good faith effort, like you said, and then come back and amend the states that are off or whatever if they're not 100% ready. Is what you're saying? Okay.
Short answer, yes.
Okay.
The best approach, if we can generate the report, is generate the report and file it
Yep.
I always recommend we're not just doing data entry. We should be doing some validation review of the information to make sure that it makes sense and is accurate. But so long as that validation has been done, yes, file it. And then continue to do reviews. And if there was a field that was incorrect or inaccurate that you discover as you're doing additional reviews, then go back and refile.
Got it. Okay. Okay, perfect.
Let me touch on one other quick point because this dovetails in two areas. The call report has actually added new fields, and those new fields are to represent changes in the pipeline. So as an example, at the end of Q4, I had 20 loans in process. The NMLS will now populate the starting number for Q1 was 20 loans in process. If, however, I actually only have 18, there is a new field to identify that reduction of the 2 loans. This is different from the change in applications where we said, oh, we had 20 loans in process, but the loan amount changed. So now the loan amount is this new number. This is actually, there's a difference in the number, the quantity of loans as well as the total loan amounts. When we use this field, we have to provide an explanation for why there's a difference. One example of why there is a difference, and I actually think this is another good positive with version 6, it has been clearly explained loans for a business purpose should not be included in the mortgage call reports. The only place business purpose loans should be included for call report purposes is in these new state addendums, the state specific supplemental form or the SSF. That is the only place, if a state requires and instructs, we should be reporting business purpose loans. So in my same example, if we had 20 loans in process at the end of Q4, but then identified 2 of those were actually business purpose loans. For Q1 of 2024, it's going to default that same 20 loans. We will now need to use these new fields to reflect the accuracy of the pipeline. We'll reflect 2 loans and those loan amounts have been reviewed. And the comment section will be used to identify the 2 loans that were removed were loans for a business purpose. And that will explain to the regulator why there's that change. The other area where this may be important is there's been additional clarification on the reporting of pre-qualifications. There have been a lot of talk in office hours held by the NMLS. There will be some changes to the FAQs that are posted in NMLS on the definitions for pre-qualification. But the short version is follow the concept under ECOA for a started application, not a complete application. That is, under ECOA, it says an application may be started based on a verbal or a written request for credit, period. If that application or that request for credit is denied, under ECOA, that denial is a denial of an application. So the denial is predicated on having an application to deny. It is not a complete application under HMDA. The call report for version 6, and according to many regulators even before, says if we have a ECOA application that was started and denied, that should be reported as an application taken during the quarter and denied during the quarter. The denial date will be used as the application date. So this may be another area where lenders need to look at their systems and processes to ensure that a pre-qualification that may not even have a subject property address would not be reported for HMDA, but resulted in a denial to a consumer would now be reported and included in the application count for call reports. Does that make sense?
Sure. There's a lot of information there. So yeah, I mean, I think you gave a lot out there and people picked up on little bits here.
Reach out. I would love to answer more questions. And again, refer folks to the NMLS Resource Center where a lot of this will be broken out as well.
One last question I had that I just thought of that, this came up the other day. We were talking, we had a client, I think we came to y'all. So what do the states, and I'm sure it differs state by state, but just in generality, consider a servicer? Servicing their own loans, interim servicing, full book of business, just licensed? What do they consider?
Yeah, this is the best compliance answer ever. It depends. What I will say is where there is generally consistency is interim servicing is generally not included as servicing. Okay. So The most restrictive state that I'm aware of is likely New York, and they actually impose a 90-day time frame. If you sell the loan within 90 days of closing, you are not servicing that loan. You would not need a servicing license or authority to perform that activity.
Got it.
Some lenders have to service by accident. We have a loan that we had to buy back or that ends up, on a repurchase or something like that. Try and resell that as quickly as we can. So long as our general business practice is not servicing loans and we're only holding loans long enough to be able to sell it, that's generally referred to as interim servicing, is not included in the elements of servicing for call reports and licensing authority. For other states, it really is going to be a state-by-state analysis. Some lender licenses cover the authority to perform servicing. Some states do not have a license requirement to service. Other states will permit you to service under your license, your lender's license, if you originated the loan and you are only servicing your loans. And other states will require you to have a distinct servicing license for performing any servicing activity, regardless of whether you originated or you're originating on behalf of another. And just one other final point, owning an MSR, so being the owner of the mortgage servicing right, even though the servicing may be sub-service to a third party, is generally covered as servicing activity.
Okay. Okay. Well, perfect. Well, thanks. Hey, Troy, anything we're about to get into probably your sweet spot? Anything you wanted to add here on the MCR kind of?
Yeah, I was just going to ask sort of a similar concept. Is broker clearly defined in the new MCR version? I understand servicer gets a little wiggly. Brokers often do too. If you toss in things like table funding and the like, is that clear? And what about somebody who lends almost exclusively, but every once in a while brokers loan?
Yeah, great questions. Let me deal with the last one first. So in the NMLS, we have our business activities, and we're required to check each box for each business activity we'll perform. The requirements to fill out the call report are based on the business activities a lender or an entity has indicated, both at the beginning and end of a quarter. So if on January 1st, our business activities indicated mortgage brokering, lending, and servicing, then that entity will be required to fill out the call reports applicable to each of those areas. If in a different scenario, at the start of the quarter, someone only indicated brokering, but by the end of the quarter also indicated lending and servicing, well, then they're going to be required to file all three because within that quarter we identified. The opposite scenario, if January 1st, we only identified brokering, and the end of March, we only identified brokering, then only brokering will be dictated. The NMLS will not per se get into the nuance of what activity creates being a lender or which activity is specific to a broker. That will be more on a state-by-state analysis of what the license authority and type is. So not greater clarity in terms of what those roles or definitions may be from the NMLS side, but some greater clarity on what fields are required to be populated based on the business activities checked. To your point, generally speaking, table funding is still mortgage brokering. Even though the loan may be closing in a mini core or a broker's name, because the funds are coming directly from the creditor, it will be sold immediately or upon closing to the investor. Those loans or that process is still generally considered mortgage brokering. But if a lender identified in their business activities that was actually mortgage lending, then for call report purposes, or again, have to fill out both of those sections. Whether that activity goes only in the broker sections or in the lending sections is probably something we should talk through more thoroughly based on the individual facts and circumstances of each scenario.
Yeah. And then one other point to sort of close the loop on there is you mentioned some strategies about if you're, May 15th tomorrow, right? So if you need to file late or not, and what kind of information you would file, what's the penalty if somebody doesn't, not ready to file by tomorrow but has to? What's the downside there?
Yeah, so again, there's somewhat of a state-specific answer. Certain states like Connecticut, it's actually in their statutes that if you do not file by the deadline, it's a violation of the statute and you have to pay a fine. Now, having spoken with some of the folks in Connecticut, if you have a data issue, if you're not capable of creating the reports, and you reach out to the regulator and explain that, then they likely will not fine you for filing late. In that scenario, they would rather have you file a couple of days, a couple of weeks late with accurate information instead of all zeros. But if you have notified them to explain why, if you are only in 1 or 2 states and those states have extended their filing deadline, then I would likely not file by May 15th. I would file within their extended deadline, but with the accurate information. So really, there have to be kind of 3 buckets. There's, where are you licensed? Are you licensed only in states that have given grace periods? Are you licensed in states that do not have grace periods? Or are you licensed both in states that have grace and not? And so depending on which bucket you fit in would probably dictate the strategy to follow.
That makes sense.
Dustin, you're on mute, buddy.
Sorry, I had somebody out my yard that was being loud. Sorry, I put it on mute. Thank you. So yeah, let's jump in. We can kind of jump into the next kind of topics. I was thinking from here, Troy, why don't you give us just an overall update? I have a few kind of specific things we can talk about, but just an overall update of what, you've been seeing with the regulators, and yeah, just kind of what you've seen over the last year. I know we've seen a lot, a bunch of different, HUD being picky, different entities, stuff like that. So why don't you just give us an overview, Troy, and Josh and I can jump in where we feel appropriate.
Yeah, and I'm happy to chat just a little bit, and Josh chime in, of course, and Dustin as well. So we have seen some different approaches by different people. I'll start at the federal level, and then we can talk states too. And Josh, I know you deal with the states a lot, and so maybe you have a ton of information there too. So at the federal level, the CFPB, we have been seeing a clear concentration on things like things that are hot topics, in my view, always have been, but it sort of cycles through. So in particular, on the fair lending side, we've seen a lot of activity there. We can dive into some of that if people like, after, in the second section here, but a real focus on fair lending. We have also seen a clear focus by the CFPB on the LO comp side, LO compensation rules side, and there was, you'll probably recall, there was a summary, a highlights provision that came out last summer really, that talked about people paying differently bond versus in-house loans. That's an area that is sort of surfaced, and some interesting language. You can't quite tell what the language specifically means in that summary, just because it's so short and it's out of context really. But I think the industry has interpreted that really as being essentially the CFPB's thoughts on prohibiting people paying differently for brokered transactions versus in-house transactions. But again, the language is not perfect because it's so short and out of context, but I think that's the way the industry is thinking of it. But the CFPB has been doing some sniffing around and talking to people there. RESPA Section 8 in particular, I think there's some definite interest there. So I think in kind of a broad-based form, the CFPB is talking to people, sometimes going after people with regards to the types of rules that they've always had in place and had jurisdiction over, and they're just sort of percolating along. Again, out of the ones that I think are most serious, and this dovetails with other regulators like DOJ and HUD, but I think fair lending is probably the one that they're most focused on, most serious about, in terms of ramping up. And then HUD generally, I mentioned HUD a moment ago in the fair housing context, the fair lending context. HUD definitely is poking around on fair housing, but in addition, HUD's FHA, not the Fair Housing Act, but the actual FHA insurance program, there have been a number of the different mortgage review board cases, in large part, I think, because people are sometimes not notifying HUD of certain developments in the HUD and the HUD requirements under the HUD handbook, where people potentially, because they have not, sometimes they've reduced staff and whatever the case has been, but the mortgage industry itself has been fairly choppy waters for a lot of people. And so there are certain triggers in the HUD requirements where you have to notify HUD of certain developments, and people sometimes are not doing that. HUD has sent out a pretty big stream of mortgage review board notices of violation that oftentimes relate to this. They can relate to other things too, other failures and so on, but a lot of times it's simply just not paying attention to the requirements under the HUD handbook. So there's a fair amount of those. The mortgage review board cases, we do a fair number of those, and oftentimes they are just failure to notify something that probably wouldn't get a lender in trouble, except that they failed to notify somebody. So let me stop there for a second, Josh, if you want to jump in, or Dustin.
Let me clarify real quick. So when you say that, you're talking, I think HUD calls them specifically notice of material events. That's what you're.
Yeah, sorry, that's right. So
Yeah.
a notification requirement that you just let HUD know, hey, I tripped over this wire and I'm letting you know. And if you do that, it's not likely that you're going to get, you may have to take some steps. You may have to have a corrective action plan. You may have to figure out ways to, for example, to improve your net worth. But, it's usually not going to get you in trouble if you're proactive on it.
Yeah, that's it's funny you said that. That's true. The one we've seen the most this year is the 20% operating loss requirement. Yeah. I think a lot of people just truthfully probably just don't know that's even out there.
Right.
Just trying to be communicated, and I think everybody's talking about it and stuff, but that's just I think everybody knows the big ones, net worth, changing control, changing any ownership, like stuff like that they have to notify of. But the 20%, when we come in and do audits, we'll come in and get the 4 quarters worth of rolling like income, and then do that calculation, and we'll notify a client. They'll be like, wait, what? That's even a requirement? So I think that's the big one we've seen, at least on our side. I don't know if there's others, Troy or Josh, y'all have seen that are other key ones.
That's a big one, particularly considering the market we've been in. I don't want to steal the thunder, but the consecutive quarter of losses for IMBs in particular, banks as well, but particularly IMBs, independent mortgage banks, many lenders have suffered a 20% operating loss quarter to quarter. To Troy's point, that in and of itself is not an issue so long as we still meet the net worth requirement. But failing to report it and failing to identify the action plan or the corrective action taken or will be taken to address that or explain, have you seen the market lately? That's why, but we're prepared for it and we're still able to, continue on. That's what HUD's looking for. The other one that I would just kind of public service announcement, I would implore all lenders to look at. There was a change, not that new, but that all lenders have to have a UEI, the unique entity identifier, and that UEI needs to be registered with sam.gov. It not only needs to be registered, but it needs to be active. And so there's almost a 3-step process you have to go through with sam.gov. The first is the assignment of the number, then the registration, and then moving it to active. If you didn't have a UEI, HUD has likely already sent you the MRB notice. If you have a UEI, HUD has not likely sent you an MRB notice because the number is there. But do yourselves a favor, double check with sam.gov to check the status of the UEI. And if it doesn't say active and registered, that means you still have more action to take. And eventually this will be something that HUD will identify because they do cross compare against the governmental systems. So that's one where we've seen lenders unknowingly run into some hot water as well.
Yeah, we had a few at the end of the audit season that they couldn't do the leap because of that exact issue. So, Troy, go ahead.
I was just going to say, and I'll note that, you know, HUD, two things really. One is HUD doesn't like to talk about itself this way, but if from a mindset perspective on these notifications, if you think of HUD as an insurance company on the FHA side anyways, if you think of HUD as an insurance company, then it kind of makes sense, you know, whether we running an insurance company would choose the same triggers or not for notice, who cares? HUD has these notifications, and its purpose is to allow them to make sure that they feel comfortable that their insurance pool really is covered and is not put in too much jeopardy. So that's the first thing. The second thing is that the questions that circle around things like UEI are the types of things, or some sort of state settlement, for example, that trips up a lot of people as well, that they just don't notify HUD of a state settlement or payment of some sort of a fine. Often people run into problems there. It's the types of things that HUD, which does have relatively limited staff to focus on this kind of an issue, they're easy checklist items that HUD field people and people internally can just kind of go down the list and find these items that are violations, and you know, they take that stuff seriously. So you want to make sure that you're proactive and you're notifying HUD when you need to on these types of items, and make sure that you're going through, your compliance team is going through on these different items to you know, to conform to the requirements, you know, regardless of whether you think that they are not likely or important or are important. You know, they're pretty easy to find and to send people letters about.
Real quick before I move on, I just want to highlight a couple of common trends we've seen with clients going through HUD audits and HUD exams. One is what the treatment of what HUD refers to, or FHA refers to, as affiliates. Not a specific definition, but my definition is vendor. Basically, anyone you're coming in contact with associated with FHA lending, you need to be running through LDP, GSA, and your exclusionary list searches at least twice a year, so every 6 months. So that is not just your employees, not just loan participants, but any vendor you may be working with. And then I think the other is, make sure to review the 4001 and the QC plans, because some of the HUD examiners are being pretty thorough or exacting, not just on validating the QC plan itself, but which areas of the business are monitored by or included in QC oversight. Some of them may not be as on its surface apparent as they should be. Things like marketing review. Has QC been involved in reviewing or approving marketing content? And if not, how are you validating that all marketing is consistent with FHA requirements? So there's actually some 4001 citations that examiners have been calling out in recent HUD audits in those areas.
Got it.
One other item I would just point out, and this seems like, you know, nobody should need to be told this, but it happens sometimes, is that make sure that you pay attention if you do receive one of these letters, for example, from the Mortgage Review Board or a QC audit, whatever the letter that might come from HUD to your shop. And sometimes it comes to one of your branch offices or an office that you wouldn't expect, just because some information is sitting around in HUD somewhere from some prior information that had been filed there. Once you get one of those letters, be very proactive, and usually their cases could differ, but usually you can find a way to, if you're proactive, resolve that matter pretty early on. Sometimes we get people that they've let a letter sit in their inbox for a long time, and things have sort of fallen off the tracks. Those are much harder to find a reasonable resolution on if it's gone far down the path. And you know, the Mortgage Review Board, as an example, you know, it's an official board, and once it takes official action, it's not very likely you're going to be able to undo that. You may be able to find ways later to still reach some sort of resolution, or figure out a way to take care of that case where it doesn't involve some dramatic or draconian penalty. But the earlier on you get involved, the far better your ability to figure out either to challenge it or to show HUD that in fact there wasn't a problem that perhaps they thought was a problem, or to handle it some other way.
So it sounds like we'll probably get into this too on the state examiner side next, but like, I mean, it sounds like anything when you're dealing with any counterparty, and any advice we probably all give is like, just communicate. Just be clear on communication. It's gonna be much worse if they find something that you should have reported or you should have responded to, and you didn't, thinking it would, procrastinating or go away or something like that. It sounds like, in times like now, if you just communicate, they know, 75% of the industry is in the same spot. So like just being clear and open and upfront with them.
Two quick thoughts there. Regulators really don't like being ghosted. They want you to respond. And particularly if they've sent you a formal letter, they definitely want a response. And to quote an old friend I learned from a lot in this industry, the longer it sits, the worse it gets. Acknowledging it, responding to it, communicating isn't in and of itself going to resolve the issue, but not responding and not communicating is only going to make the issue worse. So talk to Troy, reach out to us, make sure you've got good counsel on how to reply, but definitely reply.
Well, and we'll probably get into this in the state examiner piece, because I know you've told me stories, Josh, too. Just communicating with them sometimes gets you off, because they could have stuff totally wrong. They could have, they're following the wrong guidance. There's a lot of new people, and but I guess with that, so we don't just let's jump into it for real. So like this on the state side, I mean, what are you guys seeing? You work with all 50 states, all the regulators. I mean, what are you seeing there? Hot topics, changes?
Yeah, let me pick up on that last thread and try and pull it through. There are, and I don't mean this disrespectfully, there are a lot of new examiners in the industry. And what that means is the compliance staff and lenders often know more about how the industry works, and definitely more about how their company works, than the examiner coming in. And so referring back to or remembering kind of core exam management processes and techniques is really important. Start with being respectful, kind, build a relationship with the examiner. There's this old philosophy of like, oh, the examiner comes in, put him in the coldest room with stale coffee. That is not the approach. You're probably not able to buy him lunch and bring him in, triple espresso, whatever from Starbucks, but you can give him the okay coffee in a heated room. Or in the summer in an air-conditioned room. You make them comfortable. Treat them like a person. Treat them like you would want to be treated when you walk into their office. Be prepared, but then also know your business. And so it's really important in communicating with regulators, not just when we're wrong, but when we know we're right. And so just as an example, there was a client we were working with not long ago, and they had a state exam finding, and it was related to TRID, and it was related to the checkbox that identifies to a consumer whether they have a right to protection, if they have liability after foreclosure, or whether they have protections against that. And the state in the exam said, oh, lender, you check, they may have protection, but really for our state, it should be may not. And so we reached out to the state. And again, being respectful is important. And the response went something like, at the end of the day, you're the state regulator, and this issue is a matter of state law. So we will follow the requirements that you set, but are you sure? And here's what the CFPB said about how that box should be checked. And here's some information from your state that seems to be in line with what the CFPB said. And the examiner came back and said, oh, I'm going to have to review this, brought it to the general counsel of the state. The general counsel at the state came back to all of the examiners, said, we really shouldn't be examining for which box is checked. It should just be, is a box checked? So not only was that finding removed from our client's exam, but I think it positively influenced the rest of exams for that state. And so I use that as an example because there was never a, hey, you're just wrong, pound sand. We're not doing it that way. It was, we want to make sure we're doing it the right way, and we want to make sure that we're all on the same page about the guidance we're receiving. And the regulators are willing to change. They're willing to make updates, corrections, when we can have the information to show them that their information needs to change.
Yeah, I mean, I'll use the one too. I think an even easier one to articulate. We have a common client, Josh, right? When we first started working together, the one, they were having an issue with one state, and it was around, I think, the definition of what capital was. And there was a new examiner reading this, and they would have been fighting it for months. And we got Josh and Firstline involved and reached out to the lead state examiner, and right away he's like, no, sorry, they're reading that wrong. This is what the definition should be, and got it cleared up right away. So
you're spot on. Again, being knowledgeable, knowing what the requirements are, is really important to arguing your case. You can't really say, oh, I'm right because I think so. It's, I'm right and here's why, or this is the way I think it should be. And in that example, there was a misunderstanding in the new person reviewing, that they were intertwining 2 points that should have been separated. And once we separated those points and identified how both were being met, it was very easy for the head of the department to say, that's the way it's always been. Just let us know when it's submitted that way. And it was, to your point, it was cleared, I think, in a matter of days.
Yep, 100%. Troy, anything on the state side you wanted to add? Anything you all are seeing on the state?
No, I think Josh is spot on there, and it's really just, we have limited resources, especially now in the companies. A lot of times, when people are right sizing, they've cut back in a variety of different areas, but often that includes compliance. And then at the state level, it's a similar thing where people are coming in and often compliance folks and examiners at the state level, it's hard to get the good talent and attract good talent there. So they're always understaffed, and even when they're able to attract good talent, there's limits to their resources, and they have all this stuff going on. So I think it's important to make sure that you're keeping that dialogue and forming those relationships, because at the end of the day, it's not going to get you any favors, but it can certainly get you a comfort level so that your regulator will at least trust you when you're speaking. And I think that's important.
Got it.
Just before we jump, I just want to throw out 2 other common trends we're seeing. One related to remote work. I think this is a good win for industry that almost all states have now permitted remote work, but it's permitted remote work following a set of requirements. The first of which is have a written policy. We are seeing a lot of clients where the states are coming back and saying, yeah, we allowed remote work, but you don't have a policy, so you're not meeting the requirements for remote work. States like Oregon and Washington who say, yeah, you have to have a policy, and you at least once a year need to have a process to either, like this online or in person, inspect the remote location. So remote work, yes, big advantage, but make sure we're following the requirements there, including the written policy. Another is AML. Anti-money laundering has been around for a long time, and the requirements have existed, but not many mortgage brokers, independent mortgage banks are staying up to speed on completing the independent compliance review or the independent assessment every 12 to 18 months. States like North Carolina, when you apply for the license, will not only ask for your policy, but will ask for your last AML review. These types of issues are getting more and more important. And then to blend in the last one in the AML, cybersecurity, data information security. Make sure we are doing our training. One of the things that I think is interesting is FinCEN recently came out related to the BSA AML guidance and said paying ransomware, paying a ransom related to a cyber attack very well could constitute an AML BSA violation. The entity that's hacking you or that's asking for the ransom very well may be engaged in illegal activity. So if you are making payments to someone engaged in illegal activity, you could be violating the AML requirements. Where I think the commonality amongst almost all of these data breaches and hacks have lied is not these brute force attacks. It's largely not been outsiders being able to infiltrate all the very sophisticated security protocols that are in place. It's largely more social engineering. Someone from within the company has clicked a link, responded to an email, picked up something. Someone impersonated the president or the CEO and said, go get me that gift card, or, hey, I really need you to print this for me, click it right away. It's those internal types of weaknesses that have contributed towards these larger breaches. So please emphasize training, emphasize making sure your protocols and procedures that that everyone knows. Your president and CEO will never ask you to go buy a gift card.
Oh, okay. Well, let's jump in. Actually, I wanted to add one more from a regulator perspective, from just an accounting side, more than anything. It is just the Ginnie Mae changes. Ginnie Mae made a bunch of changes this year that went into effect for 2023 with regard to net worth and liquidity. The one they kicked the can on was the capital requirement. So if you haven't looked, I'm sure every Ginnie Mae issue, there are a few on this call I know, has probably seen them, have looked into them, have done the calculations. But they're aligning the calculations much more with banks and depositories, just in terms of risk weighting capital and stuff like that. So make sure you are looking at those before end of the year. I mean, now, to make sure you're in compliance, and let us know, obviously, if you have any questions. So I guess jumping into kind of the last topic here, the last 15 minutes or so, is just kind of, I think everybody has to be compliant. We need to be compliant. I mean, Josh, me and you we ran a whole, panel on this and at the accounting and finance conference. It's just how to be compliant the most efficient and effective way. So I guess let's just kind of jump into that, talk about that here briefly, for 10, 15 minutes, and, give your thoughts. Maybe Josh, you kick it off and then we can run to Troy. So.
Yeah, I mean, this is not going to be surprising to anyone on this call. That the state of the industry has been challenging would be an understatement. We are over 7. I would not be surprised to see 8 consecutive quarters of losses for IMBs. The standouts, the small fraction who are making money, are largely using servicing income to offset origination losses, or they're selling off servicing to cover those losses, or they are likely attached to a home builder or have very deep relationships with those who are building new homes. Those are the main areas of the market that are able to be balancing forces. So when we've got consistent quarters of losses, we have to look to the why. And the why is we're losing money on every loan. The industry historically has relied on volume as the solution to overcoming profitability issues. But when you're losing money on every loan, volume makes it worse, not better. So it has been painful. The cuts that have been made within companies, we're past the get rid of the dead weight. We are at the point of making cuts to the core that hurt. People who are like our family, who have been part of the business since the business has been going. But these are questions of survival. And we need to be making decisions on the survival of the company. This is a hard conversation to have, but they're the conversations that need to be had. Either we need to make significant changes to our operational process, or we have to shrink headcount so that we get our operating budgets back in line where we're not losing money every loan. Until then, we're just going to continue down this downward trajectory. Where I really caution folks, don't just get rid of compliance. And if you do, have a solution. We're working with a client now who had one loan with a likely $18,000 penalty. I guarantee you our bill is going to be way less than $18,000. And I don't want to, it's not done yet. So I don't want to say we're bulletproof and we've gotten them out of paying the $18,000, but it's probably there. Having the staff making sure you spend the money when you need it is actually going to save you money. Compliance, unfortunately, is often looked at where loans go to die or looked at as a cost center. But I think that perspective needs to be fixed. I will tell you, I have saved way more loans than I've killed, and I save clients way more money than I cost them. These are decisions that have to be made and the perspective looked at a little differently so we understand nobody likes writing big checks. But would you like to write a big check or a really big check? The really big check also comes with reputational harm and regulatory harm and reporting in the NMLS and to FHA and all your other regulators. There's a time and a place to save, and saving smart is better than just cutting budget at all costs. Troy, Dustin, why don't you jump in?
Troy, why don't you add some thoughts if you have some?
Yeah, I think it's sort of echoing that. I mean, I mentioned earlier in the mortgage review board context, for example, where people, they for whatever reason have not responded or have not really been proactive on that side, and sometimes even to the point where the MRB has already acted, and now they're at the point of, they have 30 days typically to respond. But it's in the context of an appeal as opposed to, or a request for hearing, as opposed to actually addressing the issue in a proactive manner early on. It becomes far more complicated and expensive that way. I think also in the context of just making sure that you are addressing your compliance issues, legal issues, in my case, on an ongoing basis, however you do that, just to make sure that it's not just pushed to the side. And some people will tell me, look, I have to focus on production first, and then I can focus on the other stuff later. I think if you take the approach of, we can have compliance in a way that helps us make money and hang on to it, or approach legal in a way that helps us make money. And if we can't get the exact result we want, like we want to do business one way and we know, or we have a good feeling that it's not permissible, there's another way often that you can get very close, if not the same kind of result that actually works from a legal perspective or a compliance perspective. You'll be far better off than if you take another sort of roughshod view of trying to do that. And making a little money today, but then paying a lot more later on is not a very good business model. But that's what, unfortunately, a lot of people are doing right this minute, I think, because the market is so choppy.
Yeah, I think you touched on it, Josh, here. And I think we talked about it in our planning, and we talked about it from the accounting side. I think much like the accounting department, the compliance departments like that, like a cost center. And being able to provide, I mean, that's what we preach in accounting type webinars or discussions, is like, make yourself a value add.
Right.
Bring stuff to the table, or find people that can. I mean, don't always just turn over and roll over. Then it is always going to be a cost center, and get the right people on board, that kind of thing. So,
yeah, I mean, really to that point, compliance is a competitive advantage. I mean, that is kind of part and parcel. I think part of this, doing more with less attitude is kind of what's necessary. I mean, it's kind of the reality of the market. It's also, though, this is the down market that those who are going to kill it 3 or 5 years from now are going to be building, not retrenching. And to Troy, you made the point, and I've been trying to emphasize this with everyone who will listen. What I think has shifted is risk appetite. Many lenders or many entities 12, 24 months ago would never have considered an activity that they're considering today because it was too risky. But now the risk appetite or the risk calculus has changed, where if I don't do this activity, or I don't approve this LO, or I don't bring on this branch, I'm afraid I have to shut my doors. And so the risk of closing my business versus the risk of the activity has shifted. And those are difficult decisions to make. But this point I'm trying to emphasize is, now is not the time to bury the skeletons. I think we're probably at the bottom and starting to get to a point of where the market will start to get better. My magic 8 ball says Q3, end of Q3, beginning of Q4, we'll start to see some green shoots. We'll start to see some recovery, and the market will start coming back. Issues like LO comp, issues like RESPA, these issues are usually identified 3 to 5 years after through examination. You don't want to be burying a skeleton in the closet now that will haunt you 3 to 5 years from now when the market's doing really well. Set yourself up for success now. Let it be hard while it's hard. Don't do something now that's going to make it hard when it should be good and easy.
Well, and why it's hard for everyone too. everybody it's hard for right now. So yeah, I guess with that, I wanted y'all each to just in the last 2 minutes before Casey sends us out here, why don't y'all each give us like one, hot topic from the legal. I mean, y'all just came back from the legal issues conference, and just one thing that we haven't talked about, maybe that they emphasize that you were surprised about, whatever. Just why don't you each go real quick before we gotta roll out.
Sure. I mean, I'll say that there is big interest and a lot of unknowns and uncertainties in the context of dual capacity loan originators who are also acting as real estate agents, or vice versa. It's a topic for an entirely different webinar or conversation, but there is a lot of activity and a lot of interest and a lot of concern about if people can take that approach. If they do take that approach, what are the risks, and how, if they do take that approach, what are the ways to try to mitigate that risk? There's lots of people talking about that, and they were talking about it at this legal issues conference as well. I think just as a general matter, there are good things to think about, and there are good ways to potentially do something in that area, but you just got to go in the best way that you can and try to mitigate the risks as you can, if you do take that approach. And I will say too, by the way, I always say this, but MBA did a fantastic job and had a lot of good people, a lot of good speakers, a lot of good topics, and so that was a good event.
Good. Okay, Josh, how about you?
You thought you were going to get a webinar without me saying LEP. But limited English proficiency, language access continues to be an important topic. This is one to me that kind of personifies compliance as a competitive advantage. I've been giving conversations or doing panels and talks on LEP for over a decade. And even for me, it just clicked more recently. If you look at the Super Bowl, if you look at any major sporting playoff event, there are commercials in Spanish. When you look at advertising from the largest companies in the world, there's advertising in Spanish. That's not because there's a requirement or a regulation saying they have to. That's because they know where the market is. So lenders are going to be serving people that speak Spanish because that's where the market is and will continue to be. So finding a way to serve borrowers and do that in compliance is a way that compliance can bring a solution that actually grows business. And to a lot of the emerging markets or typically underserved borrowers, they are not nearly as rate sensitive as other traditional borrowers that we're working with. So there are borrowers out there hungry and looking. They are clearly telling us, if you want my business, speak my language. How are we going to serve those borrowers?
Perfect. Well, with that, we have 2 minutes to wrap up. So thank you guys again for both being on. There's always a crap ton of information when y'all are on. So if anybody has any questions, feel free to reach out afterwards. With that, Casey, I won't ruin all your thunder here wrapping up. So go for it.
You can wrap up. You're totally fine.
Go for it.
Yeah, what a great webinar with a ton of content and a ton of information. I think the only constant in our industry is change. So really lucky to have both of you share your wealth of knowledge. So thanks so much. Thank you everybody for attending, and keep an eye out for the recording. It should come through in the next day or so. We also do a quick survey at the end. If you guys would be so kind to fill it out, it really helps us sort of gear either our next webinar, change things, what have you, so we can stay relevant. So other than that, thank you everybody. Have a great day.
Thanks
Thank you,
everyone.
guys.
Thanks so much.
See you
Have a
soon.
great day. Thank you.